Hello YouTube, Herman Williams with ATM Financial Services. Today's Money Smart lesson is actually a continuation of the last lesson where we began talking about retirement planning. We talked about how to get started and how to increase your contributions over time. It is that part that I want to expand on today. But before I begin today's lesson, I have a request to make. I would like to ask each of you to please share my videos with your friends and family. Everyone can benefit from increasing their financial knowledge. It is true what they say, knowledge is indeed power. Even if a particular lesson is not relevant to you, someone in your social network may be in dire need of that information. So help me share the word so that we can all share the wealth. Thank you for your support. Now, on to today's lesson. How to increase your retirement saving contributions. Now, in the last lesson, I talked about how to get started with your retirement plan and the importance of taking advantage of employer matching contributions. I also discussed the importance of increasing your contributions until you reach the maximum limit. I want to elaborate on that point a little today and do a little math to illustrate how making incremental increases to your retirement plan may not be as painful as some of you may think. Let's use an example of someone making $45,000 a year. And let's assume that in this example, this person has managed to increase their contributions over time up to the 6% maximum matching contribution limit. Now, this person is getting all of the free money that his or her employer has to offer, but in order to reach their retirement goals, they need to continue making incremental increases to their contribution rate. So in this example, this person is considering increasing their contribution from 6% to 8%. Now, this is where some people tend to get cold feet, or they tend to make the math a little too simple when trying to decide if they can afford to increase contribution. Now, let me explain what I mean. We already stated that this person has an annual salary of $45,000 and is currently contributing 6% of salary before taxes. Now, for the sake of this argument, I'm only going to deal with federal taxes. So let's take a closer look at what the 6% of salary actually cost. If no savings were being taken out, that $45,000 salary would be taxed at 22% under the latest tax rates, and a federal tax of $9,900 would be deducted, leaving an annual income of $35,100. Now let's calculate the tax bill after the 6% before tax contribution. Take the $45,000 times 6%, and that equals $2,700. So $45,000 minus the $2,700 leaves a taxable amount of $42,300. $42,300 times 22% tax rate leaves a tax bill of $9,306. That's a tax savings of $594. So what that means is the $2,700 that went into your retirement savings only cost you $2,106. So as you can see, the before tax contribution is not a dollar for dollar reduction to your take-home pay. Using this same example, if we were to increase our contribution from 6% to 8%, what would the net cost of our contribution be? Well, 8% of $45,000 is $3,600. That represents a $900 increase over our 6% contribution. But that $3,600 pre-tax contribution reduces our taxable income to $41,400. Now our new tax bill is $9,108 instead of $9,306. That's a tax savings of $198. So we increased our retirement contribution by $900 a year, but it only cost us $702. And you thought you would never use that math you learned in school. We have to think differently about how we manage our money and understand the benefits of tax-deferred savings. This was just a simple example of how making incremental increases to your retirement contribution may not be as painful as you thought. Most of you may have already known and understood this concept, but sometimes it helps to be reminded of the true cost and the true benefits of committing to building your retirement savings. When you're on a tight budget, saving an additional $900 a year can seem like a lot. But when you realize you are getting it for a cost of only $700, all of a sudden it doesn't seem so bad. Well, that concludes this lesson. I just wanted to reiterate some of the points we made in the last lesson and encourage you to look at the big picture when planning for your retirement. Please stay tuned for future lessons that will further build your knowledge as we get into some of the mechanics of how the stock market works, understanding some stock market terminology, and arm you with more tools to reach your financial goals. With new knowledge comes new behaviors. So until next time, behave well.